What's up, guys? Todd here with tradinganalysis.com. Just want to give you a quick update here, what I'm seeing in the markets, what's going on the new business launch. So I'm working hard on a wealth management business. I can't say too much because we're still pending approval. We have all documents in with New York State. Yeah, it'll be New York State registered until you get over a certain assets under management. Then you go to the SEC. So all is well, moving along very quickly, and I'll certainly keep you updated as more information becomes available. And drop us an email, drop us a line if you would like to be kept up to date on that. So very exciting times. I've been working for this for years, so the time is upon us. So what's going on in the markets? Well, we have a pretty good tech rally going on. We're in the middle of earnings season. Earnings have been great. There's been a really good move up following a pretty good triangle consolidation that I want to look at and focus on and kind of look at the psychology behind these triangles, overlay some of the sentiment, and look back at sort of the collective they that I put them in quotes, and trying to convince us for a whole bunch of reasons to get out of the market, sell your equities, embrace the fear and the sort of the scare tactics that are being put out there just to grab your attention so you bump their advertising dollars, right? But what it costs you is exposure, and I think we're in a very, very strong tech bull market. So let's jump into it. So as I mentioned, the market was in a pretty good consolidation here from February all the way into June. And as, again, they were trying to tell us we're in a bear market, all we're doing is going into a sideways triangle, and we've eventually broken higher. Now, one of the biggest reasons is the coming inflation scare. And as I overlay the 10-year yield here, you can see that rates have been going, and just here in about February into March into April is when that 10-year yield pushed up about 1.6, 1.7. And that's when they're saying that, okay, here's the great rotation out of tech that's worked so well into the old economy sectors like industrials, energies, materials, and financials, which are more interest rate and inflation sensitive. Well, rates topped off here, and all the NASDAQ did was go sideways before we just broke higher. Apple's done well, specifically some of the chips. NVIDIA's done extremely well. Guys, I still think we're in a big tech bull market. So I have traded for the last 20 years, and I'm really proud of that because it's something like, I kind of think of it as like karate, okay? Like self-defense. You only use it when you need it. Otherwise, you don't go out looking. You don't go out picking. Looking to pick a fight. I own, a trading business, and it's wonderful. But I've always been very clear to say, don't trade with any more than 20% of your investable assets. They need to be in the long run portfolio that is riding this big bull market that we're in, despite what they're telling you, right? So I want to be able to call upon those tools, call upon those weapons, to. I hope that wasn't culturally insensitive. I really didn't mean to say that. The idea is to be able to call on these weapons when you need them. And if we do get a bout of real volatility, we can go in and possibly hedge, make some movements to limit ourselves on the downside. But again, I love that I spent the last 20 years learning how to trade and learn really how these markets work rather than just gathering assets and being a marketer. And unfortunately, not to label blanketly the entire wealth management industry, but a vast majority of them have just been focusing on building assets and not really studying the market. So I think I'm coming in sort of a different way. So let's go back. There's been a couple other occasions where the collective thought process out there was trying to scare you out of positions. And two big market examples that were similar to this sort of triangle were 2016 and 15 in the NASDAQ. So let's go back and check that out. So this was a pretty big market sell-off back in 2015, but what was happening is the market was very concerned about underperformance in Chinese equities. And it seems like every time we sold down to the lows here in August, trying to scare you out. And here in the latter part, Brexit was really starting to gain traction, and everyone said, holy cow, Britain is leaving the EU. I mean, this is another major reason to sell. And all it did was trace out this five-wave kind of higher low, lower high consolidation pattern, which is a triangle that ultimately just broke higher. Same deal here, guys. In 2019, we had sort of a quiet April into October consolidation before we had a nice move higher. Then coronavirus hit, boom, got hammered, came all the way back, and here we are up at the highs. As I'm going into the wealth management, the one thing that I really am trying to focus on is I'm speaking to people about the idea of loss of principal, and certainly that's granted. In 2000 tech bubble, or 2008, or even coronavirus sell-off was pretty nasty. But for anybody who has a long enough timeline, okay, and even if somebody's 60, your investing horizon is still 30 years. The biggest fear I think people should have is not so much loss of principal, unless you're right up to the point where you need to start withdrawing that money for your living costs. It's not loss of principal, it's loss of purchasing power. And the one thing that is happening now is we're finally starting to get a move up and out of this sort of really low end of inflation readings. And this is obviously from the Fed's unbelievable pumping of money into the system to combat the economic shutdown that came from coronavirus. Okay, so we had coronavirus, but we also do have deflationary forces that are pushing prices down in the US, similar to what we had in Japan, namely 3 specific reasons that we talk about a lot, which is technology, which is making companies more efficient. It's displacing a lot of workers, cutting costs, making operating margins better. This is why the margins on these companies are unbelievable, especially as they go towards more software services and subscription models like Apple. So that's only going to increase their efficiency, profitability, but it is inherently deflationary. The other reason is people are living longer. Instead of a 65 or 70-year-old life expectancy, people are going in the 80s and 90s, no problem now. So the need for yield has been extended out. And that's going to push more people into fixed income to try to gain some kind of real yield based on the old models, which is you need to have, say, a 60-40 portfolio, 60% equities, 40% fixed income. But people are starting to rethink that because people are living longer. And also we are starting to see inflation, which is making it very difficult to earn any yield in fixed income because inflation is wiping out what you're making on the fixed income return. So here's core PCE price index year-over-year change. This is the Fed's preferred measure of inflation. You can see through 2000, 2010, 2020, we're pretty much below the 2.5% mark, and all of a sudden, bam, up to 3.5%. The next resistance level is February of 1989 at 4.7%. So we do certainly have more room to go. And here's what I was talking about with trying to earn some money on fixed income. So this is the U.S. corporate AAA effective yield, okay, minus consumer price index. So what this means, the AAA bonds are the highest grade investment grade bonds out there, okay, but if you take the average according to this index, the average yield, subtract the year-over-year CPI, consumer price index increase, that's how much your money is being devalued year over year. Effectively, by holding this, you're losing 3.5% per year. Right, inflation right now is up around 5%. And I don't know if we're going to stay up at these levels. We're seeing a lot of indications that prices are coming off. Take a look at like lumber prices. Take a look at other commodities. Some of these, the big catchphrase out there is this inflation is transitory, because what happened was companies tooled down during coronavirus, didn't think there'd be so much demand, and then all of a sudden, demand was like, oh no, we shouldn't have gone this way, we should have gone this way. Demand was much greater than supply in terms of wanting goods and services. So inflation shot up, and now the companies are trying to retool, open back up, increase their production capabilities to meet demand, and that should cool off prices, right? So crude oil hasn't gone crazy. Lumber did one of these. So, is it transitory? Possibly. Okay, possibly. But for now, this is what we're dealing with. So right now, it's hard to make the argument that we want to hold fixed income in here because you're losing money when you factor in CPI. Now, this was a very interesting article from the Wall Street Journal citing Jeremy Siegel, who's very famous in the investing community. This was back in February 2016. And of course, I'm cherry picking headlines a little bit here. But what they're saying here is stocks for the long run, question mark, not so far this century. So basically what he's saying is the argument that Jeremy Siegel and many others have made is stocks are the only way to overcome loss of purchasing power, and that's why you want to have more equities than fixed income. And he's saying that hasn't happened this year. Yet as compelling as the logic is, it hasn't panned out so far this century, excuse me. In the chart below, you can see the total return provided by bonds has handily bested U.S. stocks and downright trounced international stocks as measured by the broad Vanguard Group Index mutual funds. So what they're saying here, stocks for the long run, not so far this century, from 2000 to when this article is written, the Vanguard Total Bond Index return was up 126%, where the S&P was only up 75%. Pretty amazing, actually, from pre-tech bubble crash to when I captured the chart, July 29th, 2021. What's interesting though, again, that's why I'm just trying to bring your attention to the fact that you don't want to always follow the financial media. And guys, I'm in the financial media. I've been on CNBC for 10 years. I love them. Some of my greatest friends in my industry that I work with are at CNBC. But you don't always want to just go by what the media is saying and fall victim to some of the attention-grabbing headlines that are really just trying to get your attention. So again, you keep eyes on the papers. That's everyone's business. Everyone wants to have fancy advertising to get people into their stores to spend money. That's just the way capitalism works. It was right about here. This is when that article came out. And then look what the S&P did. It went up. So now for the 21st century, the S&P is up 353%, where fixed income is up 173, so it's double. So we certainly had mean reversion. This is very much the case that stocks over the long run is certainly better way to go, especially when we're starting to get inflation. And that's why I was saying that, be careful of what they're trying to convince you, which is this great rotation out of technology, because all of a sudden these interest rate sectors are starting to come back. They've been massively underperforming for a long period of time. And now there was started to be like a bear market bounce. They were trying to come back. Again, financials and industrials and materials and financials. And I think I already said that, but rotation out of tech. And again, I think we're in a massive tech bull market that people aren't really talking about. This is not only the most hated bull market of all time. This is the most hated technology bull market of all time. We could have a long discussion about all the amazing ways that technology are changing our lives, but it's happening right now. Unfortunately, we have a lot of side stories that are distracting us. One of those stories is weakness in China recently. And I'm sorry, but I always kind of chuckle about this because China had their growth period in the 70s, 80s, into 90s. So since 1988, S&P has returned 1,616% compared to Hong Kong's 993%. So still good, but the S&P is far better than China. But take a look at this chart in Hong Kong, the Hang Seng. We made a high in 2005. We tried to break above it, slammed. And look, we've been underperforming for what? Let's call it since the credit crisis. So 2008, so I'll call it 14 years. Hong Kong has been underperforming the U.S. Want to throw Shanghai on there? Sure. Return September 1, 2007. If you bought right before the credit crisis crash, the S&P is up 189%. Hang Seng's down 3%. Shanghai is down 38%. Guys, China's been underperforming. So 2007 minus 2021, call it 14 years. It's not new news. It's been there. So we're looking at a sector rotation now. This is using Optima and RRGs. I like to look at how the sectors, the 10 major sectors, rotate around the benchmark S&P. And the further up into the right you are in the leading quadrant, the more momentum and the more relative strength you have to the benchmark S&P. And you can see technology through 2021 has been way out to the right, but it's been kind of falling from the leading quadrant into the weakening, pulling back here. XLC Communications is out here and to the right. We actually started to hook a little bit up into the right there. XLY, which is consumer discretionary, is still leading, but again, heading in the same direction as technology. So are we rotating out of tech, communication, and discretionary as materials, industrials, and financials are rotating in, and even energy, which is like way out here, it was so massively underperforming because it's so far into the left. We are starting to rotate back in here in energy, but you can see it's so far out there. If we go to the weekly, what you're going to see here, guys, is, look, this is the weekly chart. So rather than look at month over month over month, this is week over week. Look at XLK, technology ripping back into favor. XLC, communications, just steadily holding its own right in here, not doing too much there. And even XLY, consumer discretionary, starting to move in. So there's then this whole debate over value versus growth. I could show you more RRG charts, but I'll tell you basically that they were trying to say that growth was rotating out when value was coming in. That is being unwound. We're seeing a move back into growth in this new higher interest rate, in this new higher inflationary environment, which my point is you want to have exposure to stocks to combat inflation, specifically when you combine that with the massive earnings that we're seeing in technology with, again, being in the most hated technology bull market of all time. I think it's amazing what's happening out there. within technology, okay, there's been a lot of debate as we're coming out into earnings here, what the best technology stock is. The biggest position I hold is Apple, followed by NVIDIA. Then I have XLK and QQQ. I need to up my Google. And I kind of lost track of this one as I've been more focused on building out the business. But look at Google. Google is rallying up here in the monthly, heading up into the right as Facebook, Netflix, Microsoft, Amazon, and Apple are all rotating out. Very interesting. That's the monthly. Here's the weekly. Google's just already winning with Facebook. But Google just did this little hook up and trying to get back into the leading indicator, which Facebook is falling away. So I got really, really interested to watch how Google does and Facebook does. Facebook had a very interesting announcement about the metaverse. I'm super bullish on the future of VR. These are the Oculus goggles. I think we're going to be living our lives not behind all these computer screens, but we're going to have goggles or glasses or nice form-fitting glasses, and we're going to be able to have meetings with your family. You're going to have business meetings. You're just going to be able to interact in this online metaverse, which, how do you think you could produce all that computing power? What do you need to make all these massive machines work very quickly to compute and present an environment that looks real? You need processing power. You need chips. You need semiconductors. Take a look at what NVIDIA is doing. Unbelievable. So where does that leave us, guys? I think we are still in a very big tech bull market. Just kind of giving you a loose Elliott wave count of where I think we're going. I think we easily have into the 25,000s incoming years in the NASDAQ. I could be wrong. I always could be wrong, and hopefully I'll do my best to manage risk if in the event that I'm wrong. But guys, they've tried to take us out of positions in 2016. They tried to do it here in 2018 and 2019. Coronavirus did feel pretty nasty as we're going through that, but we just went right back up to the highs. I think it's really hard to fight this trend. I think it's really hard to try to be underexposed in equities because you see real loss of purchasing power because we are seeing inflation in certain parts of the economy, and stocks in the long run have proven to be the best hedge against that. So that's one of the main messages and main focuses that I have going into the wealth management business. So guys, hope that helps. If you don't mind, throw a thumbs up, question, comment on there. I'll be doing more of these videos, guys, and thanks for listening. Have a great day.